Imagine a business that looks like it was literally engineered in a laboratory, to just perfectly extract wealth from the global economy.
Yeah, the ultimate money printer, basically.
Right. I mean, we are talking about a company with net profit margins sitting comfortably over 50%.
Which is just staggering.
It's unheard of, and a return on invested capital that approaches 40%. Plus, a business model that is so remarkably resilient, it actually gets a built-in automatic raise whenever global inflation hits.
Yeah, it sounds completely invincible, like a bulletproof compounder.
Exactly. But here is the kicker. Now, imagine that exact same company stock abruptly dropping almost 20% in early 2026.
Right.
So what on earth did Wall Street see that we are missing?
Well, I mean, it is the ultimate financial paradox, right?
Yeah.
You have this enterprise operating at a level of historical greatness that, honestly, very few entities in the history of capitalism have ever sustained.
Sure.
And yet the market suddenly blinked. The certainty just cracked.
Well, welcome to the deep dive. Today, we're tearing down the engine of Visa.
Mm-hmm.
We're putting this massive financial behemoth through Warren Buffett's moat test and Peter Lynch's growth metrics just to figure out if this 2026 drop is, a terminal decline or literally the buying opportunity of a decade.
But to actually understand that tension, like the friction between Visa's historical dominance and the sudden panic we saw in the markets, we have to start by completely dismantling the biggest misconception out there.
Oh, absolutely.
Because the vast majority of people fundamentally misunderstand what this company actually does.
Right. Let's get right into that because, I know I have a Visa card in my wallet right now.
We all do.
Yeah. And the natural assumption for anyone, looking at that piece of plastic is that Visa is a bank.
Right. That they hold your money.
Exactly. Like they gave me the card, they set my credit limit, they charge me an annual fee.
Mm-hmm.
But our source material makes a really definitive statement right out of the gate. It says Visa is not a bank.
Not at all.
They do not lend money, they do not issue physical cards, and they have absolutely nothing to do with setting your interest rates.
Precisely. I mean, if you strip away the branding, the shiny logo on the plastic, Visa is simply the digital connective tissue sitting in the middle of global commerce.
Okay, connective tissue.
Yeah. And to see how this actually works mechanically, we need to break down what the payments industry calls the four-party model.
Right.
Almost every time you tap or swipe your card, there are four distinct entities involved. And Visa is merely the invisible fifth element tying them all together.
Okay, let's map out that transaction because I think this is where people get lost. Let's say I'm walking into a local coffee shop, right? And I buy a latte.
Classic example.
What is the actual sequence of events there?
Okay, so party number one is the card holder. That is you, initiating the transaction.
Right, I'm holding the cup of coffee.
Exactly. Party number two is the issuer. That is your bank. The institution that actually extended the credit to you or holds your checking deposits.
Okay, so let's say it's Chase or Bank of America.
Right.
So Chase is the one who actually mailed me the plastic.
Exactly. Chase is the issuer. Now, party number three is the merchant. That's the coffee shop itself.
Got it.
And party number four is the acquirer.
The acquirer. Okay, who is that?
This is the merchant bank or their payment processing partner. It's the institution responsible for taking the transaction data from the coffee shop's little terminal and ensuring the funds eventually land in the coffee shop's checking account.
Okay, wait. So I have my bank, Chase, and the coffee shop has its bank. We have four parties.
Right.
I haven't heard the word Visa yet. Where do they actually step in?
Well, Visa sits squarely in the center of the chasm between those two banks.
Oh, I see.
Visa provides the digital rails. It's a proprietary communication network known as VisaNet.
VisaNet.
Yeah. When you tap your card for that latte, the coffee shop's terminal doesn't talk directly to your bank. It can't.
Right. They don't have a direct line.
Exactly. It sends an encrypted message to the acquirer, which then sends it to Visa.
Okay.
Visa then routes that authorization request over to your bank, Chase, to verify you actually have the funds.
Right. To make sure I'm good for a $5 latte.
Right. Your bank says yes, sends the approval back to Visa. Visa routes it back to the coffee shop's terminal, and boom, your latte is approved.
And all of that routing across multiple massive institutions happens in, what, about 1 second?
Less than a second, usually.
It's wild. But let's look at the economics of that single second, because this is where I think consumers, and honestly politicians too, often get mad at the exact wrong company.
All the time.
Because you hear merchants complaining endlessly about the swipe fee, right? The 2 or 3% they lose every time someone uses a card.
Right, the merchant discount rate.
Yeah, and the natural assumption is that Visa is just sitting there hoarding all of that swipe fee money.
Right, and that is the great swipe fee myth.
Really? A myth.
It is crucial to understand the mechanics of how that fee is actually divided up. The largest chunk of that 2 or 3% is a component called the interchange fee.
Okay, interchange.
And Visa does not keep the interchange fee.
Wait, they don't?
No. That fee is paid by the coffee shop's acquiring bank directly to your issuing bank.
So, wait, the acquirer pays the issuer.
Exactly.
So my bank, Chase, is taking the lion's share of the merchant's money.
Yes, precisely.
Why does the merchant's bank have to pay my bank? I mean, I'm the one buying the coffee.
Well, it is essentially a transfer of value to compensate your bank for taking on the risk. They're lending you the money, floating the funds during your 30-day grace period, and this is the big one, funding your rewards program.
Oh, the cash back or the airline miles.
Exactly. That interchange fee funds the miles that incentivize you to use the card in the first place. Visa just sets the rules for these interchange rates, creating a standardized marketplace, but Visa does not collect that massive chunk of revenue.
Okay, then what does Visa actually get out of this?
Visa takes a microscopic fractional toll for letting the data cross its bridge. We're talking a few basis points.
Yeah.
A tiny fraction of a percent.
Seriously, just a fraction.
Just a fraction.
It sounds like a casino. Like
Right.
Visa is the house that takes a microscopic rake on every single hand dealt at every single table without ever actually sitting down to bet its own chips.
That is an incredibly apt analogy, really, especially when you consider the concept of risk.
Right.
Because they are never betting their own chips, they are insulated from the traditional dangers of the financial sector.
Let's unpack that. Think about the mechanics of a credit default, right? If I go out, I max out that Visa-branded credit card, and then I lose my job, I default on the debt. The assumption most people have is that Visa takes a massive hit.
But based on the four-party model we just walked through, Visa didn't lend you a dime.
Oh, right.
Yeah.
My bank lent me the money.
Exactly. So your bank has to write off that loan, not Visa. Visa bears absolutely zero credit risk.
Wow. Okay, what about fraud? What if my card details are stolen in some massive data breach and used to buy, I don't know, thousands of dollars in electronics?
Well, the liability typically falls on the issuing bank, or sometimes the merchant, depending on the specific compliance rules at the point of sale,
Yeah.
but not Visa.
Not Visa. Okay, what if a consumer initiates a chargeback because a merchant shipped a defective product?
Again, the merchant and their acquiring bank absorb that financial blow.
So the entire system is structured so that literally everyone else holds the bag.
Yep.
Like the consumer holds the debt liability, the issuing bank holds the default and the fraud risk, the merchant holds the chargeback risk. And through all of this chaos, bankruptcies, recessions, chargebacks, Visa just quietly, cleanly collects its toll for moving the data.
Rain or shine, boom or recession. If the transaction happens, Visa gets paid.
That's wild.
I mean, during a severe economic downturn, traditional banks suffer massive loan losses, right? Their balance sheets bleed. They have to set aside billions in reserves.
Sure, they panic.
But Visa's economics remain remarkably clean because their revenue is tied strictly to the velocity of spending, not to whether anyone actually pays their credit card bill at the end of the month.
You know, that fundamentally shifts how you have to view this asset. It is not a financial institution taking financial risks. It is a pure technology network monetizing a toll road.
Absolutely.
And knowing that, the financial statements start to look less like a boring corporate earnings report and more like the blueprint for a macroeconomic engine.
They really do.
Let's open up the hood on their fiscal year 2025 financials.
Well, the scale is almost difficult to comprehend. We're looking at global processing volumes measured in the tens of trillions of dollars.
Tens of trillions.
With a T.
With a T. For FY 2025, Visa generated roughly $40 billion in net revenue, and from that, they produced $20.1 billion in GAAP net income.
Okay, let's unpack that term quickly. GAAP net income, just for clarity.
Right, so GAAP stands for Generally Accepted Accounting Principles.
The strict rules. Exactly. It means that after you strip away all the adjustments, all the aggressive corporate accounting tricks, and follow the strictest standardized rules, Visa has over $20 billion in pure standardized profit left over.
That means roughly half of every net dollar that comes in the door falls straight to the bottom line.
Yeah, 50% margin.
You don't see a 50% net margin in retail or manufacturing or even in most high-flying software companies.
No, it's incredibly rare.
So to understand how they generate that $40 billion, the source material breaks the gross revenue down into 4 distinct buckets. But there's a massive twist at the end that we need to dissect.
Yes, the incentives.
Right. But first we have data processing, which brought in about $20 billion.
Okay, so that is the core toll road fee. It is the revenue they generate for the actual authorization, clearing, and settlement of transactions.
The mechanics of moving the data.
Right. It is a flat per transaction fee. So if you buy a $2 pack of gum or a $2,000 television, the data processing effort for Visa is basically exactly the same.
Okay.
And they charge a tiny fixed fee for moving those bytes of data.
Makes sense. Then the second bucket is service revenue. And that's sitting at roughly $16.1 billion. And this is calculated based on the total dollar volume of payments from the prior period.
Right. So if data processing is a toll on the number of cars on the road, service revenue is a toll on the weight of the cargo inside those cars.
Oh, I like that analogy.
Yeah, it's tied to the total monetary value moving through the system.
Got it. Then we have international transactions at about 14.2 billion.
Mm-hmm.
And finally, other revenue, which covers, value-added services, fraud management tools, and consulting, that's sitting around 5.5 billion.
Right.
But wait, if you add all those gross revenue buckets up, the 20, the 16, the 14, the 5, you get roughly 55.8 billion.
You do.
But you just told me net revenue was 40 billion. Where did the missing, nearly $16 billion go?
Ah, that is the twist. And it's a critical mechanism for understanding how the network actually protects itself.
Okay, color me intrigued.
To arrive at net revenue, you have to subtract a massive line item called client incentives. In FY 2025, Visa paid roughly $15.8 billion back to its partner banks and clients.
Wait. I need you to explain the mechanics of that. Why on earth is Visa handing nearly $16 billion back to the banks? The banks are supposed to be paying Visa for using the network.
You have to think of it as the cost of loyalty.
Loyalty.
Yeah. Visa pays these incentives to issuing banks and acquiring partners to secure routing volume. Let's look at it mechanically from the bank's perspective, right?
Okay.
If you are a massive global bank issuing tens of millions of debit and credit cards, you have a choice. You could partner with Visa, MasterCard, or maybe a regional domestic network.
Right. I've seen cards with multiple logos sometimes.
Exactly. So Visa goes to that bank and structures a highly complex rebate agreement. They essentially say, look, if you guarantee that 90% of your portfolio will run on Visa rails, and if you hit specific volume tiers, we will rebate a significant portion of the fees back to you.
Oh, so it's basically a massive volume discount.
It is, but it goes even deeper than a simple discount.
Mm-hmm.
Because in many regions, point-of-sale terminals are capable of routing a transaction over multiple different networks.
Right, like the terminal at the grocery store?
Yeah. For example, a debit card might support both Visa and a local network. The merchant's software might be programmed to route the transaction through whichever network charges the lowest fee.
Because merchants want to save money.
Exactly. So Visa uses these massive client incentives to convince the banks to issue cards that prioritize the Visa network, essentially buying their way to the front of the routing line.
Buying their place in line.
Yes. It is the defensive moat that keeps banks from defecting to cheaper competitors.
So they are willingly sacrificing, 15 or $16 billion of top-line revenue just to ensure the banks stay hopelessly addicted to the Visa ecosystem.
It's expensive, but it works.
That is fascinating. But let's look closer at one of those gross revenue buckets, because the source document explicitly highlights it as the crown jewel of the entire business.
Ah, yes. The international volume.
Right. That third bucket, international transactions, which generated $14.2 billion. Why is Wall Street so hyper-focused on cross-border volume?
Well, because the mechanics of a cross-border transaction make it disproportionately lucrative.
How so?
Let's trace one. Imagine a tourist from London travels to New York and uses their UK-issued card to pay for a hotel. Or an individual in Brazil buys software online from a company based in Seattle.
Okay, so money is crossing borders.
Right. That transaction is entirely different from buying coffee down the street.
Because now you are dealing with different currencies.
Yes, exactly. The transaction involves currency conversion, navigating foreign exchange spreads, a much higher baseline risk of international fraud, and ultimately cross-border settlement between disparate central banking systems.
Like talking to different central banks.
Yes. Visa has to message the Bank of England's ledgers and the U.S. Federal Reserve's ledgers. Because the infrastructure required to execute that seamlessly in, 1 second is immensely complex, Visa possesses massive pricing power.
Ah, so they can charge whatever they want, basically.
Pretty much. They charge significantly higher fees, both in basis points and foreign exchange spreads, for cross-border volume.
So a single dollar spent across a border drops far more profit to Visa's bottom line than a dollar spent domestically in the U.S.
Vastly more.
That completely explains why, during earnings calls, management is constantly questioned about global travel recovery metrics or the growth of international e-commerce. Those are the really high-margin tailwinds.
Yes. And speaking of macroeconomic tailwinds, this actually leads us to one of the most compelling mechanical features of the entire business. We have established how the toll road works and how the margins are structured. But hidden within that service revenue bucket is a literal superpower.
A superpower.
Visa is perhaps one of the most perfectly inflation-immune enterprises ever constructed.
Okay, let's break down exactly how that works, because inflation usually crushes companies.
It destroys them.
Right. Raw materials get more expensive, labor demands higher wages, supply chains break down, but Visa actually benefits.
They do, and it comes down to elasticity and the mechanics of their fee structure.
Okay, remind me of the structure.
Remember that the service revenue bucket is calculated as a percentage of the total dollar value of the transactions. It is not a flat fee. It is a percentage of the nominal spend.
Right, so if global supply chain shocks cause the price of my morning coffee to jump from, say, $4 to $5, Visa's revenue on that specific transaction increases by exactly 25%.
Wow.
Think about the underlying mechanics. Did Visa have to hire more software engineers to process that $5 coffee?
Did they have to lay more fiber optic cable or build new data centers?
No.
They did absolutely zero additional work, incurred zero additional capital expenditure, but because the nominal price tag of the good went up, their revenue increased proportionally.
That's crazy.
They have a built-in frictionless escalator tied directly to global inflation.
Okay, let me push back on this, though, because let's look at consumer behavior.
Sure.
If inflation gets out of control, real wages often stagnate. If my rent goes up, my groceries are up 20%, and gas is skyrocketing, my budget is squeezed.
Very true.
I'm going to start making aggressive cuts. I cancel my streaming subscriptions, I stop going to restaurants, I delay buying a new laptop. If the consumer is tapped out and buying fewer items, doesn't Visa's volume drop? Doesn't the toll road just empty out?
That is the logical assumption, absolutely.
Right.
But it misunderstands how Visa captures value.
How so?
What you are describing is a shift in discretionary spending. You cancel the $15 streaming service, but that $15 doesn't just vanish from the macroeconomic system. Where does it go?
Well, I suppose it goes toward paying the higher grocery bill or the higher utility bill.
Exactly. Visa is entirely agnostic to the category of your spend. They are taxing the total wallet share.
Oh, they don't care what I buy.
They do not care if you spend $50 on luxury clothing or $50 on inflated eggs and milk. As long as the money is moving, and as long as it is moving digitally across their rails, Visa collects the toll.
They just want the swipe.
Exactly.
Yeah.
Historically, even in severe inflationary environments where unit volumes might dip, meaning people buy fewer actual items, the total nominal value of consumer spending holds steady or rises.
Because everything costs more.
Right. The pie might be sliced completely differently, less entertainment, more basic necessities, but Visa is still taking a percentage of every single slice.
They are essentially a tax on the velocity of money itself.
That's a great way to put it.
That is profound. When you combine that automatic inflation hedge with the fact that they bear absolutely zero credit risk, you begin to understand why legendary investors look at this financial architecture with, genuine awe.
Which serves as the perfect transition into our first analytical framework. We are going to evaluate the resilience of this company through the distinct lens of Warren Buffett.
Yes, let's do that. Buffett's investing philosophy is legendary for its simplicity and its rigor. He searches for a wonderful business protected by a wide, durable economic moat run by rational management and available at a fair price.
Right, the classic formula.
And looking at the source material, Visa appears to be the textbook embodiment of a Buffett compounder. In fact, Berkshire Hathaway actually owned Visa for 15 years.
Yep, a long time.
They initiated the position in 2011 and finally exited in early 2026, generating roughly a 1,750% return, inclusive of dividends.
And we should note, according to the analysis, that early 2026 exit was widely interpreted as portfolio cleanup tied to a departing investment manager at Berkshire.
Yeah.
Not necessarily a fundamental verdict on Visa failing.
Right, that's an important caveat.
Because Berkshire still holds a massive position in American Express, indicating the broader payments thesis remains intact. But let's drill down into the specific mathematical metrics that make Visa a Buffett darling.
Okay.
The most critical number here is ROIC, return on invested capital.
Okay, let's clearly define ROIC for everyone, because it's a metric that really separates good businesses from historic ones.
Definitely.
Conceptually, it measures how efficiently a company transforms the capital it invests back into profit. So if a manufacturing company spends $1 million building a new factory, how much cash profit does that factory spit out every year?
Exactly.
The source notes point out that a standard good business might earn a 10 to 15% ROIC. An exceptional business might push 20 to 25%. What are Visa's metrics?
Visa's current ROIC stands at approximately 38%.
38.
Yeah. And if you look at the historical averages, the 3-year average is 33.3%, and the 5-year average is 31.9%.
Sustaining a return on capital above 30% over half a decade at a global scale of tens of trillions of dollars is just staggering.
It reveals a fundamental truth about the mechanics of the network, which is that the heavy lifting is completely finished.
The roads are already paved.
Exactly. The core infrastructure is already built. Every incremental dollar of transaction volume that flows over VisaNet requires almost zero new capital investment.
Right.
It is a wildly capital-light business model. They do not need to constantly raise debt or dilute shareholders to fund operations. It is pure cash generation.
Quick break. This show is built on the fundamental research of Yehonatan, our lead analyst and founder. Want his tools? Click the Substack link below to get 3 free resources for this company. The full deep dive PDF, an interactive valuation model to test your own growth and discount rate scenarios, and a 20-year financial spreadsheet, all completely free. Now back to the numbers.
And the briefing highlights that Visa represents the intersection of 2 distinct archetypes that Buffett has aggressively purchased throughout his entire career, the toll booth and the consumer franchise. Let's break those down.
Okay, so the toll booth is a business that positions itself as an unavoidable intermediary in an essential economic process.
Okay.
The classic Buffett example is Moody's, the credit rating agency.
Oh.
The global debt market operates as a duopoly between Moody's and S&P. If a major corporation wants to issue municipal bonds or corporate debt, they effectively have no choice but to pay Moody's for a rating.
You can't skip it.
No, it is an unavoidable tax on debt issuance.
Yeah.
Visa operates with the exact same mechanics, but instead of taxing debt issuance, it taxes daily consumer spending.
Unavoidable friction.
Exactly.
And the second archetype is the consumer franchise. This is the Apple or Coca-Cola model. It is a brand that commands absolute global trust, deeply embedded in the daily psychology of the consumer. It grants the business immense pricing power.
Right.
Visa is that rare intersection. It has the ruthless, unavoidable mechanics of a toll booth, wrapped in the beloved, trusted branding of a consumer franchise.
But, you know, an incredibly lucrative toll booth is a magnet for competition.
Naturally.
If a business is extracting a 50% net margin and a nearly 40% return on capital, basic economic theory dictates that competitors should rush into the market to undercut them and steal that profit.
Right. I mean, why doesn't a massive tech conglomerate or, I don't know, a sovereign wealth fund just build a parallel road next to Visa's toll road and charge half the price?
Well, this brings us to a brilliant thought experiment outlined in the investment brief. It is called the $10 billion moat test.
I love this part.
We are going to role-play this out to truly understand the mechanics of a network effect.
Let's do it.
Okay, forget about stock prices and multiples for a moment. Imagine you are backed by a consortium of the wealthiest private equity firms on Earth.
I'm feeling wealthy.
They hand you $10 billion in liquid cash. Your mandate is simple. Go build a rival payment network from scratch and kill Visa. Walk me through your strategy. How do you deploy that $10 billion?
Man, $10 billion is a monumental amount of capital. I feel like I could just brute force my way into the market.
Let's hear it.
My first step is obvious. I have to get merchants to accept my new network. I take my billions, I hire an army of sales reps, and I blitz every major retailer, Walmart, Target, local coffee shops. I tell them, look, Visa is charging you 2%. I will process your transactions for 0.5%. Retailers are obsessed with margins. They will jump at that.
They absolutely love the idea of lower fees. They'll listen to you. But let's look at the mechanics of implementation.
Okay.
To accept your new card, the merchant has to update their point-of-sale software. They might need new hardware terminals. They have to train their cashiers on a new protocol.
Right, there's friction.
Before they commit to that operational headache, the chief financial officer of Target is going to ask you one fundamental question. How many consumers currently have your card in their wallet? What is your answer?
Well, my answer is, nobody yet, because I just started.
Precisely.
Yeah.
And the CFO will politely show you the door.
Yeah.
A merchant will not spend time and capital integrating a payment rail that zero consumers use, no matter how low the fees are. So your merchant strategy fails. You have to pivot. You have to go acquire consumers first.
Okay, fine. I take my $10 billion and I go directly to the consumers. I run Super Bowl ads. I offer ridiculous sign-up bonuses. I say, if you carry my new card, I will give you 5% cash back on every single purchase, fully subsidized by my $10 billion war chest.
And honestly, you will likely get millions of people to sign up for that incredible offer.
Right, free money.
They put your shiny new plastic card in their wallet. They walk down to the local coffee shop to buy a latte, eager to get their 5% cash back. They hand the card to the barista. What happens?
Oh, the barista looks at the card, tries to swipe it, and the terminal rejects it because
Right.
I never secured the merchant acceptance.
Exactly. The consumer asks, where can I use this? And you have to say, nowhere yet.
Ouch.
This is the brutal reality of the classic two-sided network effect. It is a cold start problem that money struggles to solve.
You literally need both sides at the same time.
Right. You cannot acquire merchants without a critical mass of cardholders, and you cannot acquire cardholders without a critical mass of ubiquitous merchant acceptance. You are trapped in a chicken and egg paradox.
Yeah. Okay, but what if I bypass the consumer and go straight to the institutions?
How so?
Step 3. I go to the major issuing banks. I walk into JP Morgan Chase. I know they issue millions of Visa cards. I tell them, let's partner. I'll give you a massive share of the economics if you issue my new card to your depositors.
Let's analyze the mechanics of a core banking integration. Chase has spent 4 decades building their back-office infrastructure, their fraud management protocols, and their customer service dispute resolution frameworks around Visa's specific technical APIs and standards.
Oh, wow.
You are asking them to rip out millions of lines of legacy code and rebuild their internal plumbing for a product that has zero market share.
But surely if I offer them enough money.
It isn't just about the money, it's about systemic risk.
Systemic risk.
Under regulatory frameworks like Basel III, banks are highly sensitive to operational risk. A bank's foundational obligation is maintaining the unshakable trust of its depositors.
Right.
If they issue a new, unproven card network and the authorization system crashes on Thanksgiving weekend, or the settlement layer fails, the depositors don't blame the network. They blame Chase.
That's true.
A Tier 1 bank will not risk its reputation and regulatory standing on an unproven startup, regardless of the financial incentive.
All right, I have billions left. Let's look at step 4, fraud and security.
Okay.
Let's assume I somehow convince a mid-tier bank to partner with me. I need an authorization engine. With my remaining billions, I go to Silicon Valley. I hire the absolute best artificial intelligence researchers. I buy massive server farms. I build a state-of-the-art machine learning model to detect fraud.
You can easily buy the engineers and the compute power, but machine learning models require one specific resource to function:
Which is?
training data. Visa currently processes roughly 65,000 transactions per second at peak capacity.
Oh my goodness.
They are monitoring anomalies around the clock, across 200 countries, in dozens of currencies. Their fraud detection algorithms are trained on decades of proprietary historical transaction data. We're talking trillions of rows of human behavioral patterns.
And my brand new AI has 0 historical rows of data.
Exactly. Your system is operating entirely blind.
That's a problem.
A huge one. In the payments industry, if your fraud model is too loose, you suffer catastrophic financial losses. If your fraud model is too strict, you generate false positives, meaning you decline legitimate transactions.
Which makes consumers mad.
A false positive is disastrous because the consumer gets embarrassed at the register and immediately stops trusting the card. You cannot buy 15 years of historical behavioral data. It has to be lived.
The layers of defense are incredible, but there's one final hurdle the source brief mentions, and it might be the most insurmountable. Step 5. Regulatory compliance.
Yeah, moving digital money across borders is one of the most heavily regulated activities on the planet.
Oh, I'm sure.
To build a truly global network, you must secure approvals, manage anti-money laundering or AML compliance, and navigate strict Know Your Customer, KYC, regulations in over 200 disparate jurisdictions.
Dealing with 200 different governments.
Exactly. You have to interface with the central bank of every nation you operate in. $10 billion does not buy you global regulatory approval. It barely covers the retainer for the army of international lawyers required to begin the application process.
Okay, so if I synthesize all of this, the merchant resistance, the bank integrations, the data deficit, the regulatory labyrinth, what is the actual takeaway for an investor looking at this moat?
The profound realization is that Visa's true moat is not technological. Writing the code to move a digital dollar from point A to point B is relatively trivial today.
Anyone can write the code.
Right. The true moat is a self-reinforcing behavioral equilibrium.
Behavior.
You have billions of human cardholders and millions of merchants locked into a deeply ingrained daily habit. Neither side possesses a compelling economic or psychological incentive to change their behavior, precisely because the other side isn't changing theirs.
Right.
The moat is human habit at a global scale, and brute force capital cannot easily rewire human habit.
That is a staggering conclusion. We firmly established the Buffett perspective, right? It is a wonderful business protected by a nearly impenetrable network effect, generating exceptional returns on capital. But a pristine moat doesn't automatically equate to a great investment if the business has stopped growing.
Right, need growth.
And that brings us to our second analytical framework, the Peter Lynch lens.
Peter Lynch famously managed the Magellan Fund
Right.
and authored the concept of invest in what you know.
Right. The classic advice.
He loved enterprises that were simple to comprehend, businesses whose products you could tangibly observe succeeding in your everyday life.
And Visa easily passes the initial Lynch test. You tap your phone at the bodega, you book a flight online, you see the network functioning constantly.
There you go.
Exactly. But Lynch's core obsession was always the growth trajectory, he would ask. What category of grower is this, and what are the specific mechanical levers driving the future runway?
Right. And the source material categorizes Visa, using Lynch's specific terminology, as a stalwart with the heart of a fast grower.
I love that phrase.
It's very accurate. It is a $500 billion behemoth.
Yeah.
It is far too gigantic to double its total revenue overnight. That is the stalwart characteristic.
Right. It's not a tiny startup.
Yet, remarkably, it consistently manages to compound its revenue at double-digit rates.
Which is wild for its size. How does a company of this immense scale continue to grow that rapidly? The briefing outlines 3 distinct stacking growth engines.
Think of them as independent compounding mechanisms operating simultaneously. The first engine, and functionally the longest runway remaining, is the secular transition of developing markets going cashless.
Let's visualize that transition, because the brief mentions looking at regions like Latin America or Southeast Asia.
Right.
10 years ago, if you traveled to rural Thailand, you were entirely dependent on physical cash.
You got to carry it everywhere.
Right. You were constantly hunting for ATMs because the street vendors, the local transit, the small merchants, none of them had the hardware or the banking relationships to accept cards.
But look at the infrastructure shift occurring right now. Thanks to the proliferation of cheap smartphones and mobile point-of-sale software, a massive growing share of those exact same merchants now accept digital payments via phone taps or QR codes.
It's all mobile now.
Yes. Now, mechanically, multiply that dynamic across Southeast Asia, Latin America, Africa, and the Middle East. You are looking at billions of consumers and tens of trillions of dollars of localized commerce that is currently trapped in the analog cash economy, steadily migrating to the digital realm.
And the beauty of that engine is that it's highly sticky. Once a consumer shifts from carrying physical cash to tapping a digital wallet, they rarely revert back.
They almost never do.
Every single percentage point of cash that converts to digital is permanent, recurring volume added to Visa's rails.
Exactly. That structural transition will take decades to fully play out, providing a long-term compounding tailwind.
Okay, but what about regions where that transition is already largely complete? Because that brings us to engine number 2, Nominal GDP growth in mature markets.
Right. Let's look at highly banked, mature economies,
Mm.
the United States, the European Union, Australia.
Okay.
In these regions, there isn't a massive untapped pool of physical cash waiting to be digitized. The vast majority of consumers already use cards for nearly everything.
True. I barely carry cash anymore.
So how does Visa extract double-digit growth from a market that is already saturated?
This circles back to the mechanical brilliance of their fee structure, doesn't it?
It does. Because Visa's service revenue is calculated as a percentage of the transaction value, their growth is intrinsically tethered to the broader economy.
Mm.
As long as the U.S. economy expands, as long as population grows, wages slowly rise, and natural baseline inflation increases the cost of goods over time, the total nominal value of transactions moving through the system goes up.
So Visa is permanently positioned to take a slice of an ever-expanding macroeconomic pie.
Yes, it is a quiet background engine, but its compounding effect over 10 years is relentless.
And there is a third engine stacking on top of that. Even within those saturated, mature markets, cards are still actively winning market share over cash in one specific category: microtransactions.
Right. Let's examine the mechanics of contactless technology. 10 or 15 years ago, the friction of a card transaction was high.
Very high.
We had to physically swipe it, wait for the dial-up authorization, and sign a paper receipt.
Yeah, I remember that.
For a $2 pack of gum or a $3 bus fare, the friction wasn't worth it. You use coins.
But the technology changed the behavior. Now, with NFC chips and mobile wallets, tapping a phone takes less than a second. I use my phone to tap into the subway system. I tap for a single coffee. The friction has essentially been reduced to zero.
And every single one of those tiny frictionless taps across global transit systems and convenience stores is another toll collected by the network.
It adds up fast.
It really does. When you synthesize those three engines, emerging market cash conversion, mature market nominal GDP expansion, and microtransaction adoption, the double-digit top-line revenue growth becomes highly logical.
Right.
But Peter Lynch wouldn't stop at the top line. To truly understand the wealth creation of this asset, we have to analyze the financial multiplier effect. We have to explain the mechanics of operating leverage.
Okay, let's break down the mathematics of operating leverage, because this is where the underlying business model truly flexes. Earlier, you mentioned that the core infrastructure of VisaNet is essentially complete.
Yes. The heavy capital expenditures building the redundant data centers, laying the secure fiber optic lines, developing the core authorization software, those are fixed costs. They are sunk.
So we have to look at the marginal cost. If Visa's 3 growth engines generate 1 additional transaction today, what is the actual cost to Visa to process that single extra data point?
Functionally, it is zero. The marginal cost approaches zero.
And this is the magic. Let's run a hypothetical scenario. If global spending volume grows by 10%, driving Visa's top-line revenue up by 10%, what happens to their expenses?
Well, they don't have to hire 10% more software engineers. They don't need to build 10% more office buildings.
So their costs stay the same.
Their fixed costs remain relatively flat. Therefore, a disproportionately massive percentage of that new revenue flows directly, unimpeded, to the bottom line.
Wow.
Net income grows mathematically faster than revenue. As the business scales, the profit margins naturally widen. It is a highly leveraged financial structure.
But the compounding doesn't stop there. Visa takes that expanding net income and layers on one final aggressive multiplier. This is where their capital allocation strategy becomes a weapon for shareholders.
Yes, we are talking about the share buyback engine.
Buybacks.
Because of the incredible operating leverage and the capital-light nature of the network, Visa generates tens of billions of dollars in free cash flow every single year.
They just have too much cash.
Literally. They simply cannot reinvest all that cash back into the business. There aren't enough productive projects to fund, so they deploy it to shrink the equity base.
Let's look at the numbers because they're wild. In fiscal year 2025 alone, Visa returned $22.8 billion to shareholders.
Staggering.
The vast majority through aggressive stock buybacks, and they authorized a massive new $30 billion buyback program. Let's explain mechanically why that matters so much to an investor.
Okay, let's define what a share of stock actually represents.
Right.
It is a fractional ownership claim on the company's total future profits.
Right.
If Visa is constantly entering the open market, purchasing its own shares and retiring them, the total denominator, the number of shares outstanding, shrinks consistently every single year.
So the total profit pie is growing, but the number of slices is shrinking.
Beautifully put. Let's sequence the full compounding machine from top to bottom.
Okay,
Step 1. Global spending volume grows due to cash digitization and inflation.
check.
Step 2. Because of operating leverage, top-line revenue grows, and net income goes even faster.
Check.
Step 3. Visa takes that rapidly expanding net income and aggressively buys back shares, drastically reducing the share count.
Which means the final metric earnings per share, or EPS, grows the fastest of all.
Exactly.
Volume growth, amplified by operating leverage, amplified again by a shrinking share count. It is a mathematically perfect compounding architecture.
It really is.
Okay, let's take a breath and center ourselves, because if someone is listening to this sequence of arguments, they are likely thinking, this is the most flawless business in the history of capitalism.
It sure sounds like it.
It is an inflation-proof toll road protected by an insurmountable human behavioral moat, generating 40% returns on capital, driven by a perfect EPS compounding engine. Yet, we established at the very beginning of this discussion that the stock dropped nearly 20% from its highs in early 2026.
We did. And this brings us to the critical tension of the analysis. The bear case.
We have to face the bears.
If the mechanical engine is so perfect, why did the market panic? It is imperative to examine these threats deeply, because history shows that a business with a moat this entrenched is almost never killed by a direct competitor doing the exact same thing slightly better.
Right, another card network won't kill them?
No. It is threatened when the fundamental ground shifts underneath it.
And the first crucial clue to understanding the 2026 sell-off is looking at the broader sector. Visa did not fall in isolation. MasterCard fell roughly 18 and 19% in lockstep with Visa.
And that synchronous movement is a massive signal for analysts.
Why is that?
When an entrenched duopoly drops in perfect correlation, it tells you that the market is not reacting to an execution failure by Visa's management team. The market is reacting to a sector-wide narrative shift. They're re-rating the entire concept of the payment network.
So what exactly spooked Wall Street? The source material categorizes the fears into two distinct buckets: severe regulatory pressure and the existential threat of disintermediation.
Let's tackle the regulators first, because the pressure has been mounting for decades.
They are always under a microscope.
Because Visa sits squarely in the middle of a vast, multi-trillion-dollar river of global fees, they are a perennial target. Merchants, consumer advocates, and politicians constantly argue that the toll is simply too high.
And the legal overhang is real. In late 2025, Visa and MasterCard agreed to a staggering $38 billion settlement with U.S. merchants.
Huge.
$38 billion, attempting to resolve a bitter, two-decade-long antitrust dispute over the mechanics of swipe fees.
And incredibly, even after agreeing to that mammoth settlement, prominent merchant groups immediately argued it didn't go far enough.
It's never enough.
Compounding that, the U.S. Department of Justice hit Visa with a massive antitrust lawsuit.
Ah, the DOJ suit.
Specifically alleging that Visa unlawfully monopolized the U.S. debit market by using exclusionary routing rules to essentially block competing, cheaper networks from gaining traction at the terminal.
And the Durbin Amendment context here is vital, right?
Very. Post-financial crisis regulations mandated that debit cards must offer merchants a choice of routing networks. The DOJ alleges Visa used complex pricing structures, those client incentives we discussed earlier, to essentially penalize merchants or issuers who tried to route transactions away from VisaNet.
So the legal threats are deeply structural.
They are.
But there was another highly publicized regulatory threat that hit the headlines in early 2026, triggering massive algorithmic selling.
Yes, the interest rate cap.
Right. And before we dive into it, I want to be extremely clear to everyone listening. We are stripping away all political bias here.
Absolutely.
We are not endorsing or criticizing any specific politician or policy. We are evaluating this strictly as financial analysts dissecting economic mechanics.
Just the numbers.
The proposal, floated by Donald Trump and echoed by politicians across the spectrum, was a hard cap on credit card interest rates at roughly 10%.
Right.
When that headline hit the terminals, the entire payment sector tanked. But let's pause. Didn't we spend the first 20 minutes of this analysis exhaustively establishing that Visa does not lend money and does not charge interest?
We did. And this perfectly illustrates why internalizing the four-party model is so essential for an investor. If the federal government successfully mandates a hard cap on credit card interest rates at 10%, who actually absorbs that financial blow?
It hits the issuing banks, it hits Chase, Capital One, Citi, Discover.
Exactly.
They are the institutions leveraging their balance sheets to lend the money, and they are the ones currently collecting the 20 to 25% annual percentage rates. A rate cap aggressively slashes the lending profitability of the banks. It does not touch Visa's toll road fee directly.
Correct. Visa's direct data processing and service revenues are technically untouched by an interest rate cap. However, institutional investors are not short-sighted.
They see the domino effect.
They immediately modeled the second-order effects. Let's trace the mechanics. If legislation drastically squeezes the profit margins of the issuing bank's credit portfolios, how must those banks logically respond to protect their own earnings?
Well, they have to fundamentally alter their risk models. They will severely tighten their underwriting standards. They will issue far fewer credit cards, restricting access only to prime consumers with flawless credit scores.
Right, less cards and wallets.
But more importantly for the network, they will inevitably slash the rewards programs. The points, the cash back, the airline miles, those are largely funded by the massive interest income and interchange fees.
Yes.
If the interest income evaporates, the banks cannot afford to subsidize the rewards.
And here's the cascade effect. If millions of consumers suddenly lose their rich rewards programs, and millions more are denied access to credit entirely, what happens to the velocity of spending?
The spending behavior shifts. The overall volume running across the digital rails inevitably slows down. Consumers revert to debit, or they simply spend less overall. Right.
So, while the policy is a direct catastrophic blow to the banks, it is a significant glancing blow to Visa because it artificially shrinks the overall pie of transactions they get to tax.
Precisely. The market violently sold off the entire payments complex because a structural threat to the issuer's profitability eventually trickles down to network volume.
Okay, so regulatory caps represent a very real ceiling on their growth trajectory. But let's pivot to the second bucket of fear, which frankly feels much more existential to the long-term thesis: disintermediation.
The new rails.
The threat of entirely new technological rails. We proved exhaustively with the $10 billion moat test that no traditional competitor can build a new card network. What if the future doesn't require a card network at all?
This is the defining question for the payments industry over the next decade.
It really is.
The primary threat to Visa is not someone executing their own playbook slightly better. The threat is a paradigm shift that changes the game entirely. The source material heavily emphasizes the rise of account-to-account, or A2A systems. Let's explain the plumbing of A2A. What exactly are these systems, and how do they bypass Visa?
Well, A2A systems are real-time digital payment rails that move money directly from a consumer's bank account to a merchant's bank account instantly.
Just bank to bank.
Yes. They completely circumvent the card networks sitting in the middle. The most prominent examples are government-backed or central bank-driven initiatives. Look at the phenomenal success of Pix in Brazil or UPI in India.
Oh, Pix is massive.
These systems have rapidly scaled to handle billions of transactions.
Let's contrast the mechanics. With a Visa transaction, the authorization happens in a second, but the actual clearing and settlement of funds between the banks happens later, in batches.
Usually overnight.
Right. With an A2A system like Pix or the Federal Reserve's new FedNow system in the U.S., the clearing and settlement happen simultaneously and instantly.
Exactly. And the most terrifying aspect for a traditional network is the pricing model.
Oh, the pricing.
Because these A2A rails are often subsidized by central banks as a public utility, they are frequently completely free for the consumer and either free or incredibly cheap for the merchant.
So if a coffee shop in São Paulo can display a QR code and a customer can scan it to instantly transfer funds directly from their bank to the merchant's bank with zero risk of chargebacks and essentially zero fees, why would that merchant ever want to pay Visa's 2% interchange toll?
They wouldn't. That is the core of the bear thesis. In jurisdictions where governments aggressively mandate and subsidize these instant A2A rails, they can severely blunt the growth of traditional card volume.
It's a real threat.
But the fear extends even further, pushing past sovereign currencies into the realm of cryptography and stablecoins.
This is where it gets highly disruptive. The briefing mentions persistent rumors of massive closed-loop ecosystems like retail giants like Walmart or Amazon, exploring their own proprietary stablecoins.
Right, imagine that.
Let's think through the mechanics of that. If Amazon issues a digital token pegged to the US dollar on a blockchain, and I fund my Amazon wallet with it and use it to buy goods directly on their platform, the settlement happens entirely on a distributed ledger.
Boom, instant.
The entire concept of a card network evaporates. The traditional plumbing is completely replaced by cryptographic smart contracts.
And that technological leap strikes directly at the heart of Visa's most lucrative segment, the cross-border crown jewel.
Oh, wow. You're right.
Currently, moving fiat currency internationally requires navigating a maze of correspondent banks, Swift messaging, and Visa's rails, all extracting massive friction fees. Programmable digital dollars on a blockchain can move value from a wallet in Tokyo to a wallet in London in seconds for fractions of a penny.
So if you are an institutional investor managing billions of dollars, sitting at the valuation highs of early 2026, and you see PIX achieving mass adoption in Brazil, and you hear credible rumors of tech giants launching stablecoins, you have to seriously question the longevity of the model.
Well, you'd be crazy not to.
You start to wonder if Visa's incredibly profitable toll road is about to be bypassed by a frictionless digital superhighway.
So the critical strategic question becomes, how does a $500 billion incumbent defend its moat against a fundamental shift in the underlying technology of money? Do they simply deploy armies of lobbyists to convince governments to ban stablecoins and restrict A2A networks?
They certainly lobby, but according to the brief, their actual technological strategy is much more adaptable. Rather than stubbornly fighting every new rail, Visa is maneuvering to become the connective tissue for all of them. They launched a sprawling platform called Visa Direct.
Visa Direct is a fascinating pivot. It is an infrastructure play designed to facilitate instant push payments, account-to-account transfers, and cross-border payouts. They're essentially building the routing logic for the very rails that threaten them.
It's the ultimate if you can't beat them, join them strategy. Or more accurately, if you can't beat them, figure out how to tax them.
Exactly. Let's look at their approach to the crypto threat. Visa is not ignoring blockchain. They are actively piloting stablecoin settlement on their own infrastructure.
I didn't know that.
Yeah, they are partnering with the very fintechs and crypto platforms that initially aimed to disrupt them. Their strategic pitch to the ecosystem is highly pragmatic.
What's the pitch?
They're saying, look, moving tokens on a blockchain is easy, but managing global fraud is incredibly hard.
Very true.
Navigating KYC and AML compliance across 200 jurisdictions is excruciatingly hard. Handling dispute resolutions is hard. Don't build that from scratch. Just use our APIs, ride on our institutional trust layer, and we will handle the complex regulatory plumbing, even if the underlying asset moving across the wire is a stablecoin.
Wow. So the central multi-year debate defining the stock is this. Does Visa successfully embed its APIs into these new decentralized rails, proving that its true value is in compliance and security and thereby maintain its take rate? Or do these new, nearly free rails slowly, inexorably erode Visa's pricing power and volume over the next 10 to 15 years?
Which brings us to the final critical piece of the analytical puzzle, the valuation verdict.
Right.
We have examined the unbelievable historical performance, the mechanical perfection of the compounding engine, and we have stared deeply into the modern existential threats that triggered the 2026 sell-off. So what does the mathematics of valuation look like right now, as of June 2026?
Well, to be clear to everyone listening, our sources are providing an analytical framework, not specific price targets or financial advice.
Right. Standard disclaimer.
But we can analyze the multiples.
Yeah.
Historically, because the fundamental business quality is so phenomenally high, Visa commands a massive premium from the market. For years, its price to earnings, or PE multiple, stubbornly hovered in the high 20s to low 30s. The 10-year median PE is roughly 33.5 times earnings. Investors gladly paid $33 for every $1 of current earnings because the certainty of growth was absolute.
But the narrative shift in early 2026 fundamentally altered the math. This is a classic case of multiple compression.
Let's explain multiple compression mechanically.
The actual stock price dropped significantly. But crucially, the underlying business operations did not deteriorate. Visa was still processing massive volumes. In fact, the consensus forward earnings estimates actually increased.
Right. The business is generating more profit, but the stock price is going down. Why? Because the multiplier that investors are willing to pay for each dollar of those earnings has shrunk.
Exactly.
The market transitioned from absolute certainty to a state of uncertainty regarding the long-term terminal value of the moat.
Exactly. So as of June 2026, due to that multiple compression, Visa is trading at approximately 26 to 28 times its trailing non-GAAP earnings. That implies it is trading roughly 15% below its own historical 10-year average.
And if we apply Peter Lynch's favorite valuation heuristic, the PEG ratio, the picture gets even more
We're in the
interesting.
PEG ratio.
Let's define the PEG ratio. You take the PE multiple and you divide it by the company's expected earnings growth rate. It is a metric designed to tell you if you are overpaying for growth.
Right.
With Visa's 5-year EPS growth rate tracking around 18%, the PEG ratio currently sits somewhere between 1.5 and 1.9.
Now, a strict traditional value investor following Lynch's original text usually seeks a PEG ratio of exactly 1.0 or lower.
Right. A true bargain.
So by strict historical standards, Visa is still not cheap. It is not a deep value bargain. But context is everything. A year prior, Visa's PEG ratio was trading well above 2.0.
A lot more expensive.
A PEG of 1.5 to 1.9 represents the most reasonable entry point public market investors have seen in over a decade. It is exactly the valuation territory where a growth-oriented investor might make an exception to acquire a high-quality stalwart with a deeply entrenched moat.
And the smart money, the institutional heavyweights, seem to actively agree with that assessment. The source document highlights some incredibly notable investors who are heavily backing the Visa thesis at these levels.
What are they looking at?
Consider Chris Hahn, the legendary manager who runs TCI Fund Management. TCI is one of the most consistently successful, highly concentrated funds in the world. Visa is one of their largest singular positions, comprising roughly a fifth of the entire portfolio.
And look at the thematic structure of Hahn's portfolio. He pairs his massive Visa stake alongside massive stakes in Moody's and S&P Global.
The toll booths again?
Exactly. He has explicitly, intentionally constructed a portfolio entirely out of financial infrastructure toll booths. He is betting on the permanence of the friction. Another major holder highlighted is Terry Smith of Fundsmith, often referred to as Britain's Warren Buffett.
Right.
Smith's entire philosophy is buying high return on capital, globally dominant franchises and simply refusing to sell them.
So the distinct pattern here is highly revealing. The investors aggressively buying Visa are the ones who obsess over fundamental business quality, durable ROIC, and insurmountable network effects.
Definitely.
It is never going to attract the deep value bargain hunters who screen for stocks trading at 10 times earnings, because a business of this caliber will simply never trade at 10 times earnings unless the global financial system is actively collapsing.
Exactly. So we arrive at the core valuation tension summarizing the entire 2026 scenario.
Which is?
The market is taking a long-term, highly theoretical risk. The idea that stablecoins or central bank A2A rails might gradually erode network margins over the course of a decade, and they are intensely pricing that risk into the stock today, as if the disruption is a near-term certainty. The multiple compressed purely out of narrative fear.
So if we synthesize everything, the mechanics, the moat, the threats, and the multiples, it's the final conclusion? Using the combined frameworks of Buffett and Lynch, the verdict is not that Visa is some undiscovered deep value steal. It is not a discarded cigar butt you found on the pavement.
No, definitely not. But it has demonstrably transitioned from being priced for absolute perfection to being a fair price for a wonderful business.
The Buffett dream.
Exactly. The margin of safety, the buffer against unforeseen operational hiccups, is mathematically better today than it has been in years, precisely because the broader market allowed fear to dictate the multiple.
And that leaves you, listening to this analysis, with the ultimate analytical judgment call. You have to synthesize the variables. Do you believe that the compounding double-digit growth story, relentlessly driven by emerging market digitization and pure operating leverage, will survive the intense noise of global regulators?
It's the big question.
Do you believe the $10 billion behavioral moat will hold off the genuine, creeping threat of blockchain disintermediation? Does the toll road keep collecting its basis points?
It serves as perhaps the most phenomenal case study available today regarding the profound tension between historical, entrenched dominance and the relentless wave of future technological disruption.
Let's briefly recap the immense ground we have covered today. We fundamentally reframed the asset. Visa is not a bank taking credit risk. It is a technology network running a high-margin toll road.
We broke down the mechanics of the four-party model and the genius of the interchange fee. We discovered how their percentage-based service fees act as an automatic, frictionless hedge against global inflation.
And we stress-tested the moat, realizing that a $10 billion check cannot rewrite the entrenched daily behavioral habits of billions of humans or instantly replicate 15 years of machine learning fraud data.
Then we charted the Lynch growth trajectory, observing how the conversion of physical cash, the expansion of nominal GDP, and the mathematics of operating leverage combine with massive share buybacks to create a relentless EPS compounding engine.
And finally, we face the reality of the 2026 sell-off, acknowledging that while the near-term cash flow is pristine, the long-term structural threats of DOJ regulations and invisible, nearly free new payment rails are genuinely capping the valuation multiple.
It is a massive amount of mechanical and financial theory to process.
It really is. But as we close out this deep dive, there's one final, incredibly provocative thought embedded at the very end of our source material that I want to explore. It builds on everything we've discussed about the human behavioral moat and where the technology is heading.
Consider the psychological foundation of Visa's dominance. Visa's entire brand equity, that incredibly valuable consumer franchise Buffett loves, was built entirely on human trust.
Right.
It is the psychological peace of mind that when a human being travels to Tokyo or logs onto an unfamiliar website, their physical card or digital wallet will simply work, and they will be protected from fraud. It is a human comfort.
But the technological landscape is shifting rapidly. Visa is aggressively pushing into the realm of artificial intelligence and what they are terming intelligent commerce. We are moving inexorably toward a macroeconomy populated by autonomous software agents.
Wow. Think about a decade from now. What happens when you no longer open an app to manually purchase a flight or order groceries? What happens when your personal AI assistant is negotiating price and executing the transaction directly with a merchant's AI agent in the background?
It completely upends the concept of a consumer franchise. When software is exclusively talking to software, does human brand trust still matter?
Exactly. Does an autonomous AI agent care about the comforting blue and gold Visa logo on a virtual card? Or does that agent simply scan the global network in milliseconds, seeking the absolute cheapest, fastest, most efficient settlement rail available, whether that is VisaNet, an instant FedNow bank transfer, or a programmable stablecoin on a decentralized blockchain?
That is the ultimate existential question for the next era of finance. When the complex plumbing of global commerce becomes entirely invisible to the human consumer, managed entirely by algorithms optimizing for efficiency, does the owner of the legacy toll roads still command pricing power?
It is a fascinating paradigm shift to mull over the next time you casually tap your phone for a coffee.
It certainly makes you view that simple 1-second tap in a profoundly different, much more complex light.
Absolutely.
Well, if you want to dive deeper and actually play with the mathematical assumptions yourself, if you want to adjust the cross-border growth rates, tweak the operating margins, or model out the impact of a severe multiple compression to see how it impacts the intrinsic valuation, be sure to check out the highly detailed, downloadable financial models linked right down in the description.
They are an incredible resource to put your own thesis to the test.
So remember that overarching question we started with? How a seemingly perfect compounding machine could suddenly drop 20%.
Yes, the paradox of flawless execution meeting market panic.
Exactly. When we began, the Visa sell-off looked like a murky, terrifying landscape. But hopefully, after running the underlying mechanics through the Buffett and Lynch frameworks, meticulously dissecting the plumbing of the toll road, and clearly separating the near-term regulatory fears from the long-term technological realities, the architecture of this phenomenal business is looking a whole lot clearer. Thanks for joining us on the deep dive.
If you enjoyed today's analysis, make sure to follow the show on your favorite podcast app so you never miss an episode. As a reminder, this podcast is for informational and educational purposes only and does not provide financial, investment, or legal advice. Investing involves risk, and you should always do your own fundamental research and consult a qualified professional before making any financial decisions. Thanks for listening, and we'll see you next time.